Welcome to episode 3 of Understanding REITs. In the last episode, we discussed different types of REITs and their respective considerations. In this episode, we dive deep into one particular type of REIT, the Industrial REIT. We will conduct a case study of ESR-LOGOS REIT to get a practical understanding. In 2006, Cambridge Industrial Trust was listed on SGX as an independent REIT. In the following decade, the REIT acquired 28 more industrial properties. In early 2017, ESR Group gained control of the Manager of Cambridge Industrial Trust and became the REIT's second largest unit holder. With this change, the REIT was renamed ESR REIT. As a flagship publicly listed REIT of the ESR Group, ESR REIT now has a sponsor that is able to provide it with a pipeline of quality assets and support during capital raising activities. In October 2018, ESR REIT completed its merger with Viva Industrial Trust, marking the first ever REIT merger in Singapore's 20 years of REIT history. In April 2022, ESR REIT completed its second merger with REIT Logistics Trust via a trust scheme of arrangement to form ESR-LOGOS REIT, or ELOG. Today, ELOG is a leading new economy and future-ready Asia-Pacific S-REIT with total assets of approximately $5.5 billion. We say that bigger is better because it gives us a diversified mix of tenants, translating to less risk. It also gives us more access to institutional investors, leading to a lower cost of capital. And of course, it makes it easier to grow. So what should you look out for in the annual report? The chairperson's statement usually involves a look back on the year and how differentiated ESR-LOGOS REIT is compared to other REITs, and also the company's strategic direction is embedded in the chairperson's statement. The 5-year financial highlights gives a bird's eye view of the financial position of the company. If you forage a little further, you'll come across the income statement, which shows the revenue, less all the expenses, including items like fees and interest expense, and that gives you a distributable income. The REIT's balance sheet is less complicated than those of companies because REITs have a simple capital structure comprising of just unit holders' funds and perpetual securities, if any. Now, let's speak with Adrian Chui, the CEO of ESR-LOGOS REIT's manager, who will give us further insights into how a REIT operates. Mr. Chui has more than 20 years of extensive real estate experience, particularly in the REIT sector, across property investments and divestments, funds management and structuring, capital markets, acquisition financing, M&A, and property research. So, Adrian, what are the long-term objectives at ELOG?
Well, thanks for inviting me, Kula, for this chat. I think for us, the long-term objectives of ELOG is what we call portfolio rejuvenation, to ensure that our assets quality are good. We look at executing this in 3 formats. The first one is what we call asset enhancement initiatives, AEIs in short, or redevelopment of our existing assets. Why do we do that? We want to make sure that our assets remains relevant to the industrialists of today as well as tomorrow. The second one is the divestments of our non-core assets. There are assets that have been 10-15 years ago, but today it may not be, or some of them has very small footprint or short land lease that from a risk-return perspective, it doesn't make sense for us to redevelop or do AEIs on. The third one is what we call asset acquisitions, especially our ESR Group, sponsor ESR Group's high-quality asset pipeline, as well as be able to access those assets in what we like to call a closed-loop asset portfolio ecosystem. These are the 3 ways that we will look to execute to ensure that our portfolio rejuvenation strategy continues, and in the longer term, the whole objective is to improve the asset quality of ELOG. Now, one more important part of why we want to have this portfolio rejuvenation through these three strategies is to address the underlying short land leases for Singapore industrial properties. As you'll be aware, Singapore industrial properties are generally getting shorter. It used to be 60 years, 15 years ago. It has gradually come down to 40 and down to even 20 to 30 years. If we do not address the underlying land leases with our asset rejuvenation, we will always have short land leases, and that impacts the equity premium that is required. So if we address that, then the equity premium reduces, and then the share price will react positively.
How do you hedge against volatility?
Well, Gula, volatility manifests itself in uncertainties. Uncertainties itself is risk. So when you ask me this question, I refer it to as risk management. We look at risk management in two ways. The first one is asset level risk management, as well as capital structure of risk management. And capital structure increasingly has become important because REITs pay out 100% of our earnings. So in order to have your working capital, to grow, to do your BAU, business as usual activities, you need access to capital. So asset level as well as capital risk management are important in how we manage volatility. I go with asset management first. How we look at asset management, risk management, is looking at the tenant diversification, ensuring that we have tenants that do not account for the majority of our REIT's income. So if you look at my top 10 tenants, they all account only for 27% of my total rental income of ELOG, and that even the largest tenant only accounts for 4.7%. That is tenant diversification, and it's across the different spread of trade activities, from logistics company to manufacturing companies, to even pharmaceutical companies and even data center operators. And a small part of risk management is to make sure that your tenants are actually in industries that are upcoming and not in those sunset industries. So that is on the tenant side, on tenant diversification. We also look at asset diversification. We used to be 100% Singapore, and now we have Australia, and we recently just announced the proposed acquisitions into Japan. So this is where we look at geographical diversification, because there are different economic and property cycles in this market. So again, when you have diversification, it reduces risk. Even on the expenses part, we make sure that we do not have all our contracts, be it maintenance or cleaning contracts, all amalgamate and expire in 1 year. Yes, the good part of amalgamating everything together is economies of scales. But if you do it too extreme, you may get hit with the hyperinflation situation. You have expenses basically going up. So we try to manage it by doing in different pockets, amalgamate in different what we call packages, so that we have different expiry profile when it comes to contracts. Now, capital structure, we make sure that our debt profile is flat, and the loans that are given to us are as long as possible, 4 years to 5 years. We ensure that our property is 100% unsecured or close to 100% unsecured as much as possible, so that we do not mortgage our assets to the banks, and then should anything happen, we have no more assets to be flexible enough to get financing. We also look at interest rate hedging to ensure that 2/3 of our loans are on a fixed rates basis for an average of about, let's say, 2 years. Now, because we have started to go overseas, we make sure that we actually manage FX risk. So when we acquire a property in the country, in the overseas country, we make sure that we have the local currency debt that we can borrow, so that it ensures that there is some form of capital hedge, so that you do not have a situation where the FX weakens against the Sing dollar and your capital value drops in Sing dollar terms, and in turn it affects gearing. Then we also look at ensuring that we have access to different pools of financing, be it bank loans, bond market, US Sing dollar bond market, perps, equity. So we look at both the asset management as well as the capital management, risk management framework as how we manage volatility. And the key is to achieve a balance between costs as well as risk management, because there's always a cost to take away risk. So our
hedging.
Hedging, correct. So there's a cost to it. So we're going to make sure that we balance it out, and not have a situation where you have zero risk and then you pay a lot of costs and then end up impacting the DPU.
What makes a good acquisition, Adrian?
The simple answer, which a lot of people will say, is it has to be DPU accretive. However, DPU accretion can be manufactured, or what the industry call it, financially engineered. So we just look at DPU accretion. We look at two factors: investment decision that we have to make, as well as funding decisions we have to make in arriving at the recommendation to whether to buy an asset. Investment decision is what we call at the asset level. We always ask ourselves a few key questions. Number one, is this property on leasehold or freehold? What is the location of the asset? Is this asset going to be relevant to the industrialists that we are targeting and is coming to the country? Are there any potential unutilized plot ratio that we could build on to do asset enhancement? Or in the case of overseas assets, are there any extra or spare land that is next to the existing asset that we can actually expand? We also look at the tenants that are already in the asset. Are they good quality tenants? We also look at credit profile. What kind of business are they in? Look at the cash flow stability. Is it a long-term lease, short-term lease? And we look at asking price relative to the sales comparables or transacted prices that's in the market to determine whether the asking price is expensive or cheap. And if it's slightly higher, is it worthwhile with all the factors that we have discussed earlier? These are the few key criteria when we look at in terms of the asset level to ask ourselves whether this is a good acquisition to even look at in the first place. Now, after we're satisfied with that, now we go to the funding decision. We have to fund it, right? Because you have to buy and REITs, as I mentioned, we pay out all our cash flow.
No retained.
We don't retain any earnings, right? So we look at how we fund it. We look at the cost of debt and what are the banks offering in terms of the pricing and the terms of the loan. We also look at how much we can hedge. And for overseas assets, we look at whether it's available for local debt and what is the cost of the local debt and what is the cost of hedging the income back, because hedging costs money and it eats into your DPU. And then we look at the state of the market. After we're satisfied with the criteria of the asset level and the funding decision, then we look at the overall portfolio and say, by buying this asset and funding it this way, does it improve the overall asset quality of our whole portfolio? Does it reduce the overall risk in terms of, again, asset risk diversification, as well as the debt expiry profile, as well as gearing? So if we are satisfied with more green checks than question marks, in our opinion, this is something that is a good acquisition. It's the interest of the unit holders, and then we'll recommend to unit holders to actually acquire them.
How important is the role of the sponsor in the S-REIT structure?
I think good. I mean, sponsor's role has always been very, very big discussion topic. I don't think just for Singapore REIT context, but I think in the REIT context as a whole. The important part is a sponsor. You need to understand the business model. Is the sponsor's business model in a framework of what I like to call a real estate ecosystem, whereby they focus on birth to maturity. Because if they have that mentality, it's a capital recycling platform, then a REIT as part of the group's ecosystem is a very important component of that. And any part of the ecosystem falls off, the whole ecosystem actually collapses. But if you have a sponsor who focuses on just making the biggest profit by selling off the asset, then it may not be aligned, because in such thinking, it's just the highest biggest win. So even you have the sponsor develop the best assets, the REIT do not get it, or don't have a chance to actually have it. And what generally then happens will be that the own REIT becomes assets that are not that good. If you have a sponsor that actually has that mentality of having good ecosystem, then they will develop assets that they believe will go to one of their subsidiaries whom they actually continue to manage, ensure that they put in the best tenants that's inside. This heirloom will continue to be passed down to the subsidiaries or the REITs to continue managing it. The important part of this ecosystem is always that you need to keep the tenants, you need to keep the business going, because tenants drives rental, rental drives value, and then that's the first part. So that's the first thing that you want to focus on when you look at sponsor. Then the second part, why to have a sponsor, is because real estate is a local game. You need operational platform. A sponsor who have a good regional footprint actually will then be able to actually offer you that platform in terms of property management, leasing, marketing, to continue to manage your assets. I'll give you an example. We announced recently the proposed acquisition of a Japan asset. First thing, that asset came from the sponsors, one of the sponsors' pipeline, but at the same time, I am able to leverage on my ESR Japan colleagues to continue to manage the asset, continue to lease the assets out. If I'm not part of the ESR group, I have to set up a whole platform in Japan just for $200 million asset. That doesn't actually make a lot of sense. And by having the operational platform, you have on-the-ground team, the hands and the legs are there. So any new tenants or any new proposed industry that's coming up, any potential acquisitions of third-party assets, you always have that comparative advantage because your local team is able to have the first access to these sort of opportunities. The third part of having a good sponsor is that I think it has been shown in down cycles that, or even in equity fundraising exercise, whereby sponsor comes in to actually support the fundraising. So in a way, provides financing support. And if you have a sponsor in an equity fundraising, like a preferential offer, where they are willing to backstop the whole equity fundraising, it provides the REIT with certainty of transaction, and the fact that it indirectly is providing a free insurance to the minority shareholders, and the minority shareholders actually get to rank in front of the sponsor in subscribing the units if they believe the transaction is actually beneficial to them as unit holders. So in my frank opinion, having a sponsor is very important to the overall management and the growth of the REIT, but I think the discerning factor is investors need to understand what is that model of the sponsor, business model of the sponsor. If it's into a capital recycling ecosystem and you know it's part of a vital cog in the whole ecosystem, then the alignment of interest actually is there.
Thank you, Adrian, for providing our viewers with an insider's perspective. Next week, we get an actual visit to one of ESR-LOGOS REIT's assets in the East and speak to their tenants, one of the biggest logistics companies globally.